Good evening, this is Gavin Martin here from Cornerstone Wealth for the Christian Super Centrelink and Age Pension webinar. Thanks for joining us this evening. I have Phil Watson, the digital guy from Christian Super, with us. G'day Phil, how are you going?
Very well, thanks Gavin. How's things?
Yeah, very well. Did you have any Christian Super news at all, Phil? Anything on the Christian Super front?
I guess the big thing for us is we just announced our new CEO, so that was pretty exciting. Ross Piper, who comes to us from World Vision, so we're really looking forward to seeing what what he's going to bring to bring to Christian Super. So he's obviously got a heart for what we do and loves what we do. So I'm really excited about that. So yeah, that's the big news for us.
Oh, that's fantastic. Yeah, and has he started yet, or is his?
No, so early next year. So he's just got to tie up some loose ends and. Yeah, I mean, business as usual, of course, Christian Super, but yeah, so we're looking forward to seeing him in 2018.
Fantastic.
I was just going to say, look for us at the Global Leadership Summit if you're visiting any of those. I know we're doing a few of them around Australia, so if you want to come over and say g'day, I know I'll be down in Adelaide. I'm not sure if anyone will be there, but yeah, feel free to. If you see us at a stand, we'd love to meet you guys and hear what you'd like to know about Christian Super.
Sounds good. Phil, so if you would like to open in prayer, that would be fantastic.
Certainly. So, Father God, thanks for this time to learn a bit more about Centrelink and the age pension. And Lord, we ask for your help as Gavin presents this to us, and we just ask for your help for those of us listening, that we have clear ears to hear this, and that our questions will be answered. And Father, we thank you for the technology that allows us to, just look into this stuff so that we can live a life better to serve you with our finances and with our retirement and all of those things that you give us. So, Father, we thank you for this time in Jesus' precious name. Amen.
Amen. Thanks, Phil. Really appreciate it. Just take tonight's information as general advice only. Please seek personal decisions, personal advice before making any decisions. If you do want personal advice, we can assist you by having you complete a questionnaire, meeting with you for an initial consultation where we talk through your goals, your current situation, and then talk through the pros and cons of the range of options. Often we also, for a number of you asked about, I'd like to just know how the mix of my pension and assets and employment is going to all play out, and particularly projecting it forward and trying to understand retirement affordability. Within that meeting, we do use our modelling software to help you understand that, and to most often it's actually giving comfort around the fact that your retirement will be affordable. So in that meeting, we do cover off those questions. It's currently $385. It generally goes for about an hour and a half. I can't think of a time that we didn't find a $385 worth of benefits or strategies that you could apply in that consultation. So you shouldn't have any concerns about getting your money's worth there. In terms of that might be sufficient for you, or you might there might be value in getting specific written recommendations, and that's what we call a statement of advice. That's the next stage. We can help you implement it and provide ongoing advice as well. So that's how we assist in terms of providing personal advice. So why is the age pension so important? It really is because it has such a significant impact on your retirement lifestyle. 80% of Australians receive the age pension in retirement, and if you don't receive it right away, as you eat into or utilise some of your assets, you might utilise it later on down the track. It helps make your superannuation assets last longer, and it helps you live more cost effectively with the concession cards that enable you to get cheaper access to utilities and car registration and medical costs as well. So it is an important part of your retirement solution and retirement lifestyle. That's why we're covering it off tonight. So what we'll cover tonight, how you qualify for the age pension. There were a lot of questions about that. There were many questions about how much can you work during whilst receiving the age pension. We'll cover off the work bonus, claiming the pension, income and assets, concession cards, travelling overseas, and where you can go for further information. So that's what we'll be covering off. In terms of how to provide for your retirement, in previous webinars, and so many of you asked questions about how much do I need to retire, how do I transition to retirement. We're not going to cover that off tonight, but there is a great webinar, a series of, 3 or more webinars that's available at cornerstonewealth.com.au/retire 2017, and it talks about all of those things. So if they were your questions on registration for this webinar, go back to that page, check out those webinars, because it goes into those topics in a lot more detail. This is really just covering off understanding the age pension. So 3 broad sources of income in retirement: superannuation, the government age pension, and then your own savings. But we're going to focus on the means-tested age pension. So the first criteria is your age, and so you need to reach age pension age to be eligible. It's been different for men to women, but now it's equal. So those born prior to the 1st of July 1952, for men, the qualifying age was 65. For women, it was actually less than 65. It started at 60 years of age, but it's slowly increased to be equal to men, and so that women that are born after the 1st of July 1952, the qualifying age is 65 years as well. Now, from the 1st of July, the age pension age is slowly increasing to 67. And there is actually a coalition policy to actually increase that to 70 years of age progressively, but it's not been implemented as yet. So if you can look at your age or your date of birth, you can work out what your age pension age is. This is the crucial eligibility criteria. There are some others, but they're probably less significant than the age. The current age pension age is 65 and a half, so anyone turning 65 from the 1st of July this year, the age pension age will be 65 and a half. So check out your date of birth and then check out your eligibility age for the age pension, because it's the key criteria. So this is the proposal or possible increase in the age pension. It's just a proposal at this stage. It's not been implemented, but it can give you an indication that if it does increase up to age 70, what the likely dates of birth will be for the applicable age pension ages. As I said, you don't need to worry about that at the moment. The maximum is actually 67 at the moment, so it's these age pension ages or dates of birth that apply. So once you've hit your age pension age, you are eligible for the pension as long as you are a resident of Australia, and generally the qualifying period is usually 10 years, but there are some international agreements. So if you've come from a particular country, like New Zealand, for example, there are agreements in place. So you need to understand the country that you've come from to understand what your eligibility would be. But they're the 2 criteria. You're an Australian resident and you've reached your age pension age. Once you've reached your age pension age, you don't have to retire. It's just a government legislative age at which you can access the age pension. So you could keep on working. You could scale back your workload and work intermittently or part-time. Or you could fully retire and cease work altogether. So there's no requirement to finish up at age of pension age. It's just the age at which you may be eligible for the pension. And if you do continue to work, many of you asked about this, if you do continue to work, you can actually work and earn up to $6,500 a year and it not affect your age pension. So, or you can consider it in terms of you can earn up to $250 per fortnight from employment and it won't affect your pension. You could actually earn more than that and it not affect your pension, but it depends on the mix of income and assets, as we'll talk about later. So for example, Margot earns $1,300 per fortnight. She's of age pension age and she's receiving a part pension. Of this, $250 is disregarded because of the work bonus, and so only $1,050 per fortnight is assessed under the income test. So you can earn up to $6,500 without it impacting your age pension entitlements. Now it is about the earnings amount, not the hours that you work. So it's the dollar figure, not the hours that you work, that's important. So, and you can actually accumulate a work bonus. So if you're on the commenced the age pension but weren't working and then got, say, 1 week's work, and it was, so you didn't work for 12 months, you accumulated the $250 per fortnight throughout the year, your balance, your work bonus balance, increased to $6,500. Then you could do $6,500 of work and your age pension would not be impacted. The example here we've got is that Margot didn't work for 2 fortnights and therefore accumulated $500 of work bonus. She then returned to work and earned $1,000. So including that fortnight's $250 work bonus, she's only assessed on $250. And that was only the $250 that would reduce her age pension should she be on the income test. So that's the work bonus. With couples, you can, if you're both eligible for the age pension, then you can both receive that work bonus. So it's $6,500 each. But if one spouse is eligible for the age pension and another spouse is not, they're under age pension age, then it's only the age pension age spouse that receives this work bonus. The first dollar of earnings of the younger spouse will be assessed for the income test. In terms of business income, if you have a company and you pay yourself an income, then that can be come under the work bonus system. But if you're just receiving distributions from a company or self-employment, that doesn't fall under the work bonus. So it is often best if you can structure it and you're earning these sorts of amounts and eligible for the pension. It is good to be able to classify or earn employment income as opposed to profits from companies or contracting, for example. So that's the work bonus. Many of you asked about that. So how do you claim the pension? You've reached your age pension age, you're an Australian resident, and you want to claim the pension. There's a couple of different options. The two main ones are you go to humanservices.gov.au and you apply online, or you may have a MyGov account, and I think a lot of the time they're actually requiring you to go through your MyGov account, but I think you still can do it directly through the humanservices.gov.au. You can complete the application online, or you can just apply for the claim. You can just claim it online and have the forms sent to you. Similarly, you can just phone Centrelink on 13 23 00 and you can claim the pension and ask for the forms to be sent to you. Now, there's a couple of different ways you can do it. You can do it on the date that you're eligible. So if you know that you're going to be eligible when you turn 65 and a half, on the day that you're eligible, you can call Centrelink and say, I want to claim the pension. And at that point in time, they will send you the forms. If you get those forms back to them within 14 days from the phone call that you made, then your pension, assuming you're eligible at your age pension age, will be paid from the date that you made the phone call. If you don't lodge it within the 14 days, then it will reset and your pension will start from the time that your forms are submitted. You can actually submit the forms up to 13 weeks before you are eligible, so 13 weeks before your age pension age. We've not encouraged that in the past because what happens is that you submit the form, you're rejected because you're not of age pension age yet, and then they've got to flag it to then resubmit it again later on. And you also do have to provide updates on all your your bank account balances and your investment balances, etc. So if it's 13 weeks out, you're eligible to submit it all, but they'll then ask for some updated information 13 weeks later. But it's actually becoming increasingly popular because there's such a delay in Centrelink processing these applications that if you process or you claim on your age pension age, submit the documents within 14 days, it's taking months in some cases for the claims to be actually processed. They'll be backdated, but they do take a while for the claim to be processed. So sometimes it is good to process them a little bit earlier, as long as you're happy to resubmit updated bank accounts, etc. at a later point in time. So that's how you can claim, either online or make a call 13 weeks out or on the day of your eligibility, but make sure you get your documents back within 14 days if you take that approach. You can submit most of your documentation either via fax or via post, but you do need to provide proof of identity, and you can post all these documents off, so passports, certified copies of driver's license, etc. But generally it is easier to go into a Centrelink office. They take copies of all your certified documents to prove your identity, and then you just can take them with you, so not actually sending them off anywhere, and they won't get lost. So generally that's what we do, is we submit the application either online or via fax, and then go in and have the identity check in person. As I mentioned on the previous slide, don't delay returning your documents beyond the 14 days, because you might then miss out on some pension payments. So if you haven't got all the information, still submit it, because they'll then come back to you with asking for the missing information. So it just keeps your claim alive effectively if you do stay within the time frames. Or if you can't get it done within 14 days, give them a call and you can ask for an extension as well. It'll just mean that you won't miss out on any payments. So how are the payments made? They're regular fortnightly payments in arrears, and the day that you get paid is determined just based on when you made the claim and when it's processed. You can change that day to suit you if you prefer a different payment date or a regular fortnightly payment date, and it's directly deposited into your financial institution. There is this thing called CenterPay where you can directly deduct some payments from your age pension payments that go directly to certain organisations, but I haven't got anyone that uses that service. So the pension amount is a combination of the base pension amount, a pension supplement, and an energy supplement. There are two additional payments that are included, which is rent assistance if you're renting a property rather than living in a home that you own. And if you live in a remote area, there may be a remote area allowance as well. So the amounts that you may be eligible for, or the full pensions, are for a single, and these are figures valid from the 20th of September this year. So a single is eligible for $894.40 per fortnight, so that's $23,254 per annum. So this is including just the base pension, the pension supplement, and the energy supplement. It doesn't include rental assistance and the remote area allowance. So I think rental assistance is up to about $125 per fortnight on top of that as well. So for a couple, it's $670. The maximum pension is $674.20 per fortnight each, so $17,529 each per annum, which is about just over $35,000 per annum for a couple for the full age pension. So some people have really communicated a concern about not having enough to live on in retirement. Depending on your income needs or how much you spend, the age pension could largely cover your expenditure requirements or your income in retirement. How does Centrelink work out how much they will pay you? Well, they start with the potential maximums, so $23,000 for a single or $35,000 for a couple, and they apply an income test and they apply an assets test, and whichever of those tests provides the lowest age pension, that's what rate will apply. So if the income test provides the lowest pension, then that's what you'll be tested under. If the assets test provides the lower pension, you'll be tested under the assets test. And your circumstances might change. You might be firstly working part-time, for example, and receiving a part pension, tested under the income test, and then you might finish work and then you'll change to be tested under the asset test. So your circumstances may change over time. So how the income test works for a single person is that if you're earning income less than $168 per fortnight or $4,368 per annum, then you'll receive the full age pension. And if you're earning over that amount, your pension will reduce by 50 cents for each dollar above the $168 per fortnight. And then up to the extent that if your income your assessable income is over $1,957 per fortnight, or nearly $51,000 per annum, then you'll receive no pension at all. You'll become ineligible for the age pension. But if you're earning somewhere between there, then you could be receiving a part age pension. Now, this is where we see a lot of people miss out on the age pension, because they might be earning, say, $30,000 a year, still working, and not realising that they're eligible for a part pension whilst they're still working. So factor that in if you are working part-time or working on a single person earning less than $51,000 and of age pension age. The income test for a couple is, so it's based on the combined income. So what they do is they include the income of both couples, regardless of whether both of you or one of you is eligible for the age pension, and then it's effectively split in half. So it's on your combined income that's the assessed income, and therefore the rate is higher than a single. So the maximum, you'll receive the maximum age pension if your fortnightly income is less than $300 or less than $7,800 per annum. And each person's pension is reduced by 25 cents in the dollar. So effectively, combined income is reduced by 50 cents in the dollar for each dollar that you earn over that threshold. So you can earn up to nearly $3,000 per fortnight, or just under $78,000, and receive a part pension. So that's the income test and how that applies. So some people have asked about how can I, how much should I work and earn to optimise my pension payments? Well, you're always going to be better off to be employed, because your pension reduces by 50 cents for every dollar earned. So you're always going to be better off by working, but it's a matter of how much you want to work and how to balance that with the age pension as well. But you'll always be better off by earning more money. So what does income include? It includes employment income. It includes any salary sacrifice amount as well. So you can't salary sacrifice or direct some of your income to super or to a car or some other item and reduce your income and receive a higher pension. It's included in the income test. The work bonus, as we mentioned earlier, is excluded, so that $6,500 per annum is excluded. Overseas income is included. Superannuation, pensions and income streams are included. They have different ways of testing them depending on when you commence that and when you were eligible for the age pension. So it can be a little bit complex, that side of things. Rent from real estate is included, farm or business income, and deemed income from financial investments. So if you've got some money in the bank, it might not be earning anything, but Centrelink will assume that it's earning a certain level of income. So that's included in the income test. How deeming works is, so deeming is basically assuming a level of income irrespective of the actual income received. So all financial investments are aggregated together, so cash, shares, bank accounts, investments, loans to people, they're all included or aggregated together. And then the first $50,200 for a single is assessed at 1.75%, and then the remainder is assessed at 3.25%. And for a couple, the threshold is higher, so $83,400 of combined financial assets is assessed at 1.75%, and the remainder is assessed at 3.25%. So here's an example. Brian's a single person. He has bank accounts of $4,473, a term deposit of $72, and shares of $28. So total financial assets of just under $105,000. They're only earning 1% and 3%. So and plus some dividends here. So the total income is $3,324. But how Centrelink will assess it is they'll take the first $50,200, assume 1.75% interest on it, and 3.25% interest on the next amount, and so they'll assume earnings of $2,642 or $102. So even though you're earning $169 per fortnight, Centrelink will only assess $102 per fortnight. And so that's how financial assets are assessed from an income perspective. They're not just asset tested, but they're income tested as well. So how does the asset test work? So we've talked about the income test, but we also need to understand the asset test. So assets are things that you own, and there's a different threshold for those that are homeowners and those that are non-homeowners. And the reason for that is because the home that you live in is not included in the assets test. And so to make things a bit more even for those people that don't own homes, they have a higher threshold of assets. So assets above the threshold are reduced by $3 per $1,000 over the threshold. It used to be $1.50, but from the 1st of January 2017, it was doubled. So it meant less people were paid pensions, and many people's pensions reduced in January this year. So what's included in the assets test includes motor vehicles, boats, caravans, household and contents, bank accounts. So the important thing about real estate is it's the net value of real estate. So if it's your own home, it's not included. But if it's other, say it's an investment property or a holiday home, then the net value is included, which means that it deducts any borrowings against those assets. So if the asset's worth $500,000 and you've got $300,000 of debt or loan against that, then the net value of that is $200,000. That's what will be assessed from Centrelink's perspective. The net value of farms or businesses will also be included, so that's the value less any debt. Collectibles and antiques are included, and any gifting, so assets that you have gifted over the set limits, is also included as an asset. When valuing assets, they take usually the net market value. So for real estate, for example, or collectibles, etc., it's the net market value. With motor vehicles, what we usually do is look up Redbook. So redbook.com.au provides research on the values of cars. So we've got a 2014 Toyota Camry that down here when new was just under $40,000, but it's now, if you went to trade it in, it'd be worth $13,400 to $15,400. You might be able to sell it privately for $19,000, but we just use for Centrelink purposes the lower end of the trade-in price. So if you're filling out an application for your age pension, it's not a bad thing to look up the Red Book and use the lower end of the trade-in price as the valuation for your asset, for your car, sorry. That's how we generally value cars. In terms of household contents, if you say don't include a value of your household contents on your Centrelink form, Centrelink will assume $10,000, but the value is the fire sale value. So if you took all your possessions and put them out in the street tomorrow and had to sell them, what would you get for them? And so we generally say between $2,000 and $3,000 is the value of household contents at fire sale value. But it's your estimate is what they take. Real estate, it's the current market value, and if they're not happy with the value that you provide, they may actually get a valuation of that as well. They used to have their own department, but I think they've been outsourcing a lot of that work now to private valuers. And financial investments, it's just the current market value. So if you own shares, they'll ask how many shares you own, and they'll just use the stock exchange to find out what that is. Or if you've got account balances, you need to provide those balances. Now, once you're on the age pension and your assets change by more than $2,000, you need to advise them within 14 days or 2 weeks of the change, either up or down. So assets that aren't included in the assets test is your principal place of residence, including land that's on the same title surrounding that home, up to 2 hectares. If you've got more than 2 hectares, there are some rules. So if you've been using that for farming purposes for more than 25 years, sometimes that can be exempt as well. But generally for most people, it's the family home is under that land area. It's excluded from the assets test. So your home is generally excluded from the assets test. Other assets that are excluded from the assets test is an accommodation bond for aged care. So your RAD or refundable accommodation deposit, funeral bonds and prepaid funerals are excluded, and special disability trusts are as well. And one other item that we often use as an effective strategy to maximise your age pension is that superannuation in the accumulation phase, when you are under the age pension age, is also excluded from the assets test. So, for example, Paul is 66 years of age and eligible for the age pension, and his wife Jill is 58 years of age. Now, Jill's superannuation in the accumulation phase is not included in the assets test. So a strategy that we'll talk about next webinar is this particular one, where you can hold assets in the younger spouse's name and they're therefore excluded from the assets test, and there might be a period of time there that you can the older spouse can receive the full age pension for a period. If you want to learn more about that particular strategy, then tune into the next webinar as we'll go into that in a bit of detail. So what are the thresholds for the assets test? So for a single homeowner, you can have assets up to $253,000 and still receive the full age pension. And then if you have assets over $552,000, you receive no age pension at all. For a single non-homeowner, the threshold increases significantly. So the threshold to get the full age pension is $456,750, and then you can have assets up to $755,000, and it's only when you have assets over that threshold that your pension will be cut off. For a couple homeowner, you can have assets up to $380,500 and potentially still receive the full age pension. And this is where some people have, say, for example, financial assets of $300,000, and they're not so it's under the assets test threshold, but they're still not receiving the full age pension. They say, well, I've got assets less than that under the assets test. But what they don't realise is that the income test kicks in if you've got financial assets as a couple homeowner of more than $278,492, then you'll be income tested. The deeming on those assets will mean that the income test will reduce your pension. So you could have assets under the asset test but still not get the full age pension because of the deeming rules. So for a couple homeowner, you'll receive no pension if your assets are over $830,000. So as I mentioned earlier, it excludes the family home and those other assets that are excluded from the test. And then you've got a couple non-homer, the thresholds are $583,500, and then the upper threshold, $1,033,000. So before the 1st of July this year, a couple homeowner could have over $1.2 million of assets and still receive a part pension. So it's just from the 1st of Jan that these have been returned to what they were about 10 years ago, before Howard and Costello changed it as part of the simpler super rules back in 2006. As I mentioned, on the 1st of Jan, the pension taper rate reduced significantly. Now, if you were receiving the age pension and then ceased to from the 1st of Jan, you should have automatically received the Commonwealth Seniors Healthcare Card. But as part of the May budget announcements, they announced that those that were caught up in that would actually receive October this year the pension concession card, which has a greater level of benefit. We'll talk a bit more about the cards that are available, but hopefully those of you that have missed out on the pension concession card because you came off the pension on 1st of January, hopefully you've received that pension card this month already. So let's have a look at how the age pension taper rate works. So we've got an example here of Ralph, who's 68 years of age. He's single. He owns his home that's worth $600,000. He's got $27,000 in the bank. He's got a Christian pension of $250,000, shares of $50,000, and he's got a car and some golf clubs and other contents worth $20,000. So his house isn't included in the assets test, so it's not assessed at all. But his car and contents, his Christian pension, his cash, and his shares are. So his assets that are assessed for Centrelink purposes are worth $347,000. The lower asset test threshold is $253,750, as we looked at on the previous page. So his assets over the threshold are $93,250. This means that his pension will reduce by $3 per fortnight for every $1,000 over that threshold. So effectively divide 93,250 by 1,000 and multiply it by 3, and you get 279.75 is what his pension will be reduced by. If his maximum pension, the maximum single fortnightly rate is 894.40, this means that Ralph, with 347,000 of assessable assets, will receive a fortnightly pension of $614.65. So he'll need to combine that income with his cash and Christian pension and share earnings to come up with or to provide for his retirement expenditure. Let's look at a couple. So similar scenario, Sam and Sally, 68 and 72. They're both eligible for the age pension. Own a home worth 800,000, got 20,000 in cash, 600 in Christian pensions, 100,000 in shares, 20,000 in car and contents. They play tennis rather than golf. Their house isn't assessed, but all the other assets are. So their total assets are $740,000. The lower threshold for a couple at the moment is $380,500. So the assets that exceed the threshold are worth $359,500 at the $3 per $1,000 taper rate. Their pension will be reduced by $1,078.50. Their maximum pension is $1,348.40, so they'll get a fortnightly pension of $269.90. So they'll need to rely significantly on their pension and shares and cash to provide for the income requirement in the short term. But as they eat into those resources to provide for those for their retirement needs, then their fortnightly pension will increase. They'll increase for two reasons. One, their assets might be going down in value, and secondly, the thresholds index up over time as well. So you should see an increasing age pension over time for those two reasons, unless your earnings are exceeding your drawings. Gina's just asked, is this the same for the disability pension? It's the same rates of payment for the disability pension, but as soon as you exceed the lower threshold that we mentioned before, so for a couple, for example, the lower threshold of $380,500, as soon as your assets exceed that limit, you come off the disability support pension. So it is a harsher test for the disability support pension, but it's the same rate of payment. Just coming off concession cards, so when you are in receipt of the age pension, you receive what we call a pensioner concession card. Now this enables you discounts for health and pharmaceutical, transport, household bills, and there are informal entitlements to like clubs and memberships and entertainment. That depends on what business or organisation you're dealing with. But the key ones are transport and household bills. Like your utilities bills can be discounted, your registration, and there's one other I'm thinking of. Sometimes rates as well can be discounted also. So there's a fair bit of value in I generally estimate sort of $1,500 to $2,000 of benefit for a couple, for example, each year by using the pension card. But it depends on what your expenditure is and how much you spend on pharmaceuticals. So that's what you get if you're on the age pension. But if you're not eligible for the age pension, but you are of pension age, you might be able to access the Commonwealth Seniors Health Card. Now, it's not worth much when you compare it to the age pension. So it only really financially involves a $366.60 for a single or $551 for a couple. Actually, I don't think that's each. I think that's as a couple, so I should get rid of that each. So it's only worth a little bit, but it does enable you to access the pharmaceutical benefits, which is one of the primary costs that is a concern for people that have medical or health issues. So if you're of pension age, you're not eligible for the age pension due to the income or assets test, you may be eligible for the Commonwealth Seniors Health Card. It doesn't include all the utilities and rates and registration discounts usually, but it does include the pharmaceutical discounts. Now, eligibility is not based on, there's no assets test, but there is an adjusted taxable income test. So if you're a single and your income is less than $53,800, or a couple combined $86,000, or a couple separated by illness of $107,600, then you would be eligible for the Commonwealth Seniors Healthcare Card. So if you're If you're not eligible for the age pension, see if you can get onto the Commonwealth Seniors card. They changed the rules about what was included in the income on the 1st of Jan 2015. So if you've already got a account-based pension in place prior to the 1st of Jan, then sometimes it's best to maintain it because that is grandfathered. A bit of a complex discussion, but if that's your situation, then investigate a little bit further. Ross has just asked about that strategy about the younger spouse and holding super in the younger spouse's name. I won't go into it in detail here, Ross, but I'll do it next webinar just for time's sake. We'll go into a lot of detail in the next webinar, so tune into that one. Many of you asked about gifts and how gifts are assessed. You can gift up to $10,000 per year or $30,000 over 5 years, and that's rolling 5-year period, and it not be considered a deprived asset for Centrelink purposes. Anything over those thresholds would be considered an asset for the next 5 years and considered a deemed asset for that period in time. So it includes also 5 years prior to claiming the pension. So if you're turning pension age and claiming a pension, but 2 years ago gifted $100,000 to your kids, then $90,000 of that gift will be an asset until 5 years after you gifted that asset. So it will affect your age pension. So think about if you're thinking about helping your kids to get into the property market, for example, which is a very common desire. If you are 5 years out from your eligibility for the age pension, it's good to do your gifting then because it won't actually impact the age pension. But you still, even if you are of age pension age or within the 5 years of being age pension age, you still can gift $10,000 per year or $30,000 over 5 years, and it won't be considered a deprived asset. There can be benefits in actually gifting money because of the rate at which your pension is reduced due to your assets. So, for example, if we gifted $10,000, so we're eligible for the pension, we're assessed under the assets test, and we gift $10,000, your annual pension could actually increase by $780 per year. That's an interest rate of 7.8%. Now, if you compare that to if you had retained the $10,000 and invested it at, say, 3% is a good interest rate at the moment, you could get $300 for it. So by gifting some of that money, you've actually increased your income by $480 per annum. The drawback is you haven't got the $10,000 of capital to spend if you want to, but it has actually increased the income that you're receiving. So it is something worth considering as well, particularly if you're wanting to gift money to your kids, for example. You can have an overall, if you're thinking that you're wanting to be good stewards of your overall financial arrangements, including your extended family, can have some positive benefits. Gail asks, if my husband is going to get the age pension mid-year next year, but I will still be working for another 6 years on $40,000 per year, will my husband only get a part pension? Yes, because you're earning more than the $300 per fortnight, then your husband will only get a part pension. A couple of questions or a couple of slides about going overseas, then I'll open up to more questions. If you have applied for the age pension, you're receiving the age pension, you can go overseas and still receive the age pension. But if you're overseas for more than 6 weeks, the pension supplement will reduce. And so for a single person, the pension supplement is $1,700 per year, and that will, which makes up the full part of the full age pension. It will reduce to just the basic supplement of $600. So you'll, over a year, it'll be $1,100 difference in pension supplement. For a couple, it'll be $2,600 annually to $988 annually. So there's a bit of a reduction, but not massive. So you could be overseas and living more cheaply than you can live in Australia, and your pension will only reduce by $1,100 as a single or $1,600 as a couple. And when you return to Australia, the standard rate comes back again, so your full pension, including the full supplement, will kick back in when you return back to Australia. But if you are overseas for more than 26 weeks, then it's considered more of a permanent thing, and different rules start to apply. It depends on whether there's a reciprocal arrangement with the country that you're going to. The rule that applies then is based on how long you have been in Australia between the ages of 16 and 65, which is kind of the working age is what they call it. So if you went overseas before the 1st of July 2014, and you were an Australian for 25 years, working in Australia for 25 years of your working age between 16 and 65, then you get the full age pension that will continue, and all that you'd miss out on is this reduction in the pension supplement. But from now, from the 1st of July 2014, there's a requirement of 35 years within Australia at that point in time. So once you've overseas more than 26 weeks, you need to really understand how long you've been in Australia during that working period to understand how much of the pension you will receive. And it's on a pro rata basis. So if you've only been in Australia for 30 of the 35 years, it'll be a seventh or 6/7 of the pension that you will receive, because it'll be reduced based on that pro rata amount. So you need to be consider that. If you're a missionary, you've been overseas and you come back, you're of an age pension age, and you come back and you apply for the pension, and then you think you're going to go back again and stay on the pension, you can't do that either. You actually have to be in receipt of, if you weren't a resident for the 2 years prior to applying for the pension, then you can't come back, apply for the pension, and then go back overseas. You've got to be in receipt of the pension for 2 years in Australia, and then you can go back overseas and remain on the age pension. So there are some rules there about going overseas, but it is possible that you can continue to receive the majority of the age pension whilst living overseas. If you do need further information, then particularly those that asked all about how much do I need to retire, can I afford to retire, then go to cornerstonewealth.com.au/retire 2017. The next webinar is not going to be held on the 23rd, that's today's webinar, but it is next month, and I'll email you the date and the registration link if you are interested in those more detailed strategies. So we'll look at how can you reduce your income and assets test by strategies like that one of holding assets in the younger spouse's name. We'll look at other strategies that you can apply to try and enhance your age pension. So tonight's webinar is really about the basics and trying to understand the basics, how you apply for it. That's where we get into a little bit more detailed strategies. You can call Christian Super on 1300 360 997 or their website at christiansuper.com.au. And there's a few Centrelink resources. The Department of Human Services is the website, so humanservices.gov.au. There's a Senior Australians number on 13 23 00. And then if you've got questions around, what are my entitlements, there is a free financial advisors. They're called financial information services officers. Some are good, some are not so good, but if you get a good one, they can be helpful. You can book an appointment with them and at humanservices.gov.au/FIS for financial information services officer, and they can help you about Centrelink rules and how much you might get on your current assets, etc. Just help your planning process. There is a rate estimator, so if you follow this link or just search on rate estimators on the Human Services website, then you can put in all your assets and your income levels, and it'll give you an idea of how much pension you might get. There is also an Express Plus Seniors app. You can use that to, once you're registered for the with Centrelink, you can use that to report your income fortnightly basis. You can access all the information about your pension as well. So there's a few additional resources for you. Now I'm going to walk through all the questions that I received, all the questions that I received that I didn't think that I directly answered as part of the main content. If you've got questions live, then I'll focus on those first, and then I'll come back to these questions. So Stephen asks, do gifts to your local church count as gifts for pension purposes? Yeah, it does include gifts to your local church. I think in one of the Human Services website, that does get included as a tithe, does get included in that gifting amount. Yes. Working paying tax, of course. Oh, Jean's just asking about the other question. Thanks, Jean. Yes, it doesn't matter if you're working paying tax or not. It still means that you'll have a reduced pension based on the question before. Nadine says, thanks for mentioning about missionary, as that is pertinent to us. Pleasure. It can work, Nadine, if you do. You come from overseas, you come back to Australia, you work in Australia, or you stay in Australia on the age pension for 2 years, and then you can go back overseas. You can do some short trips, so you can be overseas for up to 12 weeks at a time. And there's no real rule about how often you do that, and still keep your 2 years valid. But you wouldn't want to push it to be much more than a couple of times, particularly if you're going right up to the 12-week period within your 2 year of staying on the age pension. Thanks, Nadine. Jean says, if I spend some of my super on holidays, am I deemed to still have that asset? No, if you've spent the money's no longer there, so it's no longer an asset. Yeah, so spending money reduces your assets, but you don't necessarily want to go out and spend a lot of money to reduce your assets to increase your pension, because you end up chasing your tail a little bit. But if it's a reasonable thing, or you're right on the cusp of being eligible for the pension, then it's probably okay to do. But it is a little bit of chasing your tail to go out and spend money to get the full age pension. Jane's saying, yeah, he's going to go and spend money. I hope you enjoy it. You're just going to make sure that you've got enough to support yourself longer term. So you don't want to go and spend all your money and get the full age pension, but then not have enough to support yourself longer term. So just need to balance that out. Vivian's just saying, thanks for your input, pleasure. Appreciate you have to go. Feel free to tap into the recording if you want to check out responses to some of the other questions. Feel free to keep on asking questions online, and I'll keep responding to them. Otherwise, I'll just go through the questions that we had on registration. So Jeff asked a question. Firstly, he said it relates to the spouse of a pensionable age, but other spouse still working full time. I think what Jeff's asking there is if one a spouse is eligible for the age pension and the other isn't, and the other spouse is still working full time, will you be eligible for a pension? Well, it depends on what the income level is of the spouse working, because it does impact the eligibility under the income test of the older spouse. And then the second thing is investment property making me ineligible. Well, the investment property is considered an asset. Any income generated from it, or rent or net income, so rent less expenses, is considered under the income test. So investment property will be assessed under the income and assets test. If it's just a holiday property, then it'll just be the assets test. If it's not generating any income, there'll be no income test on that investment property. Jean's just saying, thanks, very informative. A pleasure, Jean. Need to go. No worries, Jack. Thanks for being on board. James asked, age at which super will no longer be possible to take contributions into it, or take contributions into it. I think this is saying what is the age at which I can no longer make contributions to super? It's age 65 unless you satisfy a work test. So you can continue to make super contributions when you're over 65, but you need to be working at least 40 hours in 30 days once in that financial year, up until the age of 75. And then once you hit 75, the only contributions that you can make are the superannuation guarantee contributions from your employer of 9.5%. Deborah asks, at 60, I've developed a voice condition that may prevent my ability to work as a preschool teacher. What options do I have? Well, Deborah, there's a few things that you should consider. One is firstly whether you have any insurance, as in total permanent disability insurance, either outside or inside of super. You may be able to get a payout for that. And then you may be able to go on to disability support pension is another option for you. and you may be able to start drawing from your superannuation to provide for your income needs as well. So there's a combination of things that you can check out there to see how you can financially provide for yourself moving forward. Bruce saying thanks, have to go. No worries, Bruce. David saying thanks for the information, valuable information. A pleasure, David. No worries at all. Thanks for those of you who have been on board that need to leave. Appreciate your involvement. Paul asks, can I receive the age pension if I have an ATO debt? I think you still can. I don't think there's any concern there. It's just will be registered as a debt. Diane, can we afford my husband to retire? The best thing to do is go back to either a calculator that I mentioned, so the humanservices.gov.au, and look at rate estimator. You could go and see a financial information services officer, or you could go and check out the retirement planning webinars at cornerstonewealth.com.au/retire 2017, or we cover that in a fair bit of detail in an initial consultation. So a few options there for you, Diane. Christine asks, do you think the age pension will ever be phased out in light of compulsory superannuation? I don't think the age pension will be phased out, but as I mentioned earlier about the age pension age, I think that'll continue to increase. I don't think it'll be long before the age pension age will be 70 years of age, and we may see more pressure on either not increasing as much or into the future, or rates being reduced over time, because there aren't enough, because of an aging population, there aren't enough people in the workforce to support the swell, particularly of baby boomers approaching retirement and moving on to the age pension. So there will be pressure on it, but I think it will always be there. Ron asks, getting the balance right between percentage of pension support from funds in Christian Super, I'm on government part pension. Yeah, it's hard to balance those. Well, it's not that hard to balance things. If you know what your income requirements are, you draw from superannuation what you need to top up the part pension. I'm not sure what else you're asking there. James, how can I integrate retirement income sourced from the government age pension, super and part-time retired ministry? It's basically just drawing the minimum from your super, getting the age pension, and then doing part-time ministry up to your income needs. I know it's a bit tricky sometimes to manage those things, but if you start with your income requirement first, then we can work backwards to how much you need to work to actually attain that income requirement longer term. Denise asks, how can we ensure that we get the maximum age pension while also having enough for holidays, etc.? We own our own home. The maximum age pension, you just have to be under the lower threshold of both the income and assets test. And if you still want to go on holidays, you need to have some resources. Yeah, it's just about a matter of balancing those things. But generally, most people structure their arrangements with they've got their superannuation assets, they've got a cash reserve, and then they own their own home. That would probably be the most common arrangement. Actually, I'll go down a few slides to show you what I mean for that. So a very simple and common approach to structuring your assets in retirement is that you own your own home with no debt on it. For Centrelink purposes in particular, when you're of age pension age and you've got debt on your home, it actually doesn't come off your assets. So you're generally best to use some of your assets to pay off your mortgage when you are of age pension age. Don't have a mortgage on your house at that point in time, particularly if you're being assessed on your assets on the money that's either in your you own your own name or in superannuation. But a common approach is you own your own home with no debt. You have a cash reserve of 3 to 12 months living expenditure. So if your living expenditure is 50 grand a year, you might have $20,000 to $50,000 sitting in an at-call account for an emergency fund. And then generally have the rest of your assets sitting over in superannuation, often in the pension phase of super, so it's tax-free, and you can use that money to top up your age pension to provide for your income needs. So that's a really good way a really simple way to structure your income in retirement. So that was Denise. And then Rustin asked, how can I claim a UK pension? I was born there and worked there until age 30. I'm now 56. I think you just go directly through the, you can search on it, I think, and you just go through a pension, a website, a UK government website to apply for that pension. Winston asks, oh no, just saying good night. Thanks, Winston, for joining us. Rustin, Jean says, Rustin would only have worked for 12 to 15 years. Yeah, I think you still get a UK pension, but you just can apply and see. It does impact the income test for how much Australian pension you will receive. Tony's just saying, thanks, a pleasure. In the UK, yeah, no worries, Jean. It's just a matter of applying for it and seeing what you will receive. So thanks for the input there. So just the next question was, Pam, how do I reapply for the concessions cancelled January 17 and eligible again October 17? Please list, e.g. rates, electricity, etc. So if your concession card was cancelled on the 1st of Jan, you should actually receive the concession card again this month. I don't think you have to apply for it. It should just be sent to you. But if your assets have gone down or your income's gone down and you fall under the thresholds again, you just got to go through the application process again. So either call Centrelink. They may even be able to send you out pre-populated forms if you're on that pension previously. But well worth applying if your circumstances do change in the future. That is, your assets go down, or what also happens is that the asset thresholds go up as well. So it's well worthwhile reconsidering on a regular basis whether you might be eligible for the age pension in the future. But you should receive the pension concession card in the post this month if you haven't already. Carol asks, how many hours can I work before it affects my pension? It's not how many hours you work, it's how much money you earn. So if you're on the age pension, you can earn up to $250 per fortnight under the work bonus, and it won't affect your pension. Angela asks, how to best access super at retirement when super is not excessive. How best to access super at retirement? Generally, the best way to access it, you can just draw lump sums from it, or you can move it to pension phase and draw the minimum amount from it. So if you're at 65 years of age, the minimum amount is 5% of the balance. So it's just a matter of, generally we set them at the minimum, and if you need a little bit more, you can increase it as per your needs. Bruce asks how to earn income, including income earned overseas, to pay off a mortgage without it affecting my age pension. There's no way really of doing it. Any earnings over the work bonus amount of $250 per fortnight will affect your age pension if you are assessed under the income test. You may be able to earn a little bit of more income than the work bonus and it not affect you if your assets tested. But generally, you're going to be better off earning income because your pension is only reduced for 50 cents in the per dollar of earnings. So you're always at least 50% better off by earning income, particularly if you need to pay down the mortgage. Another option is to downsize, but you don't always net as much as you think when you downsize your home. Deb asks how to make money with redundancy payments. It really depends on your circumstances. The easiest way to make money is to pay off your mortgage if you've got a mortgage. Then it gets down to, well, what's the next option? Can you access the tax-free phase or the pension phase of superannuation? If you can, then often that's a great way to do it. So make a contribution to super, roll it to pension phase, and then you can earn money tax-free using that mechanism. There are things like investment properties. There's a range of options there, Deb. So consider all those and see whether you can get that redundancy working hard for you. Delaney says, we have not yet got the minimum residence requirement for age pension, though still working overseas as missionaries and are 65, 64 years of age. Now, if we return to Australia, would we be counted as residents for the purposes of fulfilling residency requirements for pension if we still travel overseas for a few weeks of ministry at a time. Yeah, you can. So I think you're asking about the 2-year rule. So if you're overseas, that is, you're not Australian residents at the moment because you're working overseas, you come back when you're of age pension age. You may, or one of you may already be of age pension age, being 65 years of age, depending on when you turn 65. So you come back from overseas, you could apply for the age pension, assuming you satisfy the residency requirements and the income and assets test. You go on to the age pension. You would then need to be effectively stay in Australia for 2 years before you could go full-time overseas. In that 2-year period, you could go overseas for periods up to 12 weeks and still remain on the age pension. You'll lose it whilst you're overseas. So as soon as if within that 2-year period, as soon as you go overseas, you'll lose the pension. But when you come back, it starts again. But after the 2-year period, then you can go overseas and remain on the pension, as long as you satisfy that next rule, which is the being in Australia for 25 years or 35 years. It'll probably actually be the 35 years during your working age, 16 to 65 years of age. Bit of a complex one, that one. So you could speak to a financial information services officer at Centrelink if you wanted to dig down into that a little bit more. Or initial consultation, we would talk that through with you as well. Does the preschool teacher know about the voice enhancer microphone worn around the neck like a necklace and a speaker for the room? In Perth, they are sold by Ziggy's. I'm a primary teacher and have used one for several years. Oh, fantastic. Thanks, Peter. I've got, I'll have to go back and look at who that was, because I might have been emailed directly. So thanks, Peter. I'll pass that on just in case that person was not online tonight and doesn't listen to the recording. But thanks for that. That's really good. I hope that's of some use. Thanks for the input and helping out somebody else. That's great. So we now need to find out where I'm at. So I think it was Deb with the redundancy payments was the last question. So Susan, how to maximise benefit. Will have minimal super at retirement within 10 years, single person. That really, so maximising your benefit between now and age pension age, the best thing to do is go through the retirement planning webinar series. So go into cornerstonewealth.com.au/retire 2017. And that will address all the things that you could consider and strategies. Salary sacrifice to super is one of the key ones. You can save tax and build your super. So go through that webinar series, and you should see some good content there that you might be able to apply to your situation and boost your retirement savings in the next 10 years. Pedro asks, I'm 66 years old. I plan to retire in 3 to 4 years. What can I do at this stage to obtain the best benefit? Well, firstly, is you need to assess whether you are already eligible for the age pension. You've hit age pension age, and then you just need to assess whether your income and assets are over the threshold or not, because you might be eligible for a part pension already, depending on whether you're working or earning income over the income test thresholds. So check that out. Ross asks, I'm retiring shortly and have some money in both accumulation and pension super accounts. Do I roll the accumulation account into the, assuming the pension phase? It really depends. The only reason you might not do that, and I think if it's Ross who asked the question about having a younger spouse, if you're both eligible if you're both of age pension age, it doesn't matter whether your superannuation money is in the accumulation phase or pension phase, Centrelink will test that as an asset. And therefore, often we say move to the pension phase, because you can move from the 15% tax environment of the accumulation phase to the 0% tax environment of the pension phase. So generally we would say move funds to the pension phase when you have reached age pension age, unless you have a younger spouse not yet eligible for the age pension. Peter asks, I have a disability superannuation pension and receive $2,608 gross per fortnight. Will I be entitled to any pension or benefits? It's an interesting one. Depends on how old you are, and so you should receive, so that should be under the fortnightly income requirement. Depends on whether you're, actually it's over the singles income threshold, but it's under the couples threshold, so it depends on whether you're a single or a couple. Yeah, depending on what your age is, you could, and whether you've got a younger spouse, for example, you could roll back to the accumulation phase rather than drawing a pension. Yeah, there's a bit much that I don't know there to provide some much useful information. Philip's in Estonia. There are reciprocal agreements, law, Jan 2018. Will it cover health in Estonia? I really don't know, Philip, but there's too many reciprocal agreements and too many countries to keep across to know that information, so best to investigate that yourself. And just got another question come through. Liz, g'day Liz, thanks for being on board. G'day John as well. And Delaney says, thanks very much, I have to leave now. No worries, thanks for being on board. I hope that my response to your question helped a bit there, Delaney. So I think we're on the home straight. I think this page of questions and I think part of the next page. Glennis asks, I will qualify in age for the age pension early next year. How do I best arrange my finances and assets in preparation? That goes down to this sort of structure, back to own your own home with no debt, have a cash reserve, and then have the rest of your funds in the pension phase at superannuation is a nice, simple and common way of structuring your assets. There are lots of alternatives to that. You can have investment properties. There are a range of things, but often that's a good, solid structure. Good, solid, simple, effective structure to hold your assets in retirement. Marilyn asks, I am 70 years of age. Can I access any age pension benefits while my husband is still working full time? It depends on his level of income. So I would check out whether you are under the income and assets thresholds. And if you are under them, then apply for the age pension immediately. You can just try to apply, but it's a fair bit of work to go through if you know that you're not going to be eligible. Suzanne asks, I'm worried I won't have enough super for retirement. I just need some insight and information. Thank you. It's really wise of you to either go and see a financial information services officer, go to the retirement planning series at cornerstonewealth.com.au/retire 2017. Use some of the calculators on the Human Services website, or there are some calculators also on, if you log on to your member online on Christian Super, there are some calculators there that you can utilise as well. I think they may have been enhanced to include the age pension as well. So you can do some modelling there about how well you'll be provided for in retirement. Irene asks, income reporting and working as a volunteer. It sounds like you might be on New Start allowance, so reporting your income and working as a volunteer. If you're on New Start, as in not on the age pension, then you can do some volunteer work, and that counts as some of your activity work and still receive the New Start allowance. If you're talking about being on the age pension and you're doing some volunteer work, if it's not paid work, it doesn't matter. You don't have to report anything. It's only when you generate income that you need to report it. Volunteer work doesn't come up on the Centrelink's radar at all when you're on the age pension. Doris asks, is there any tax if I give some money or assets to my children in retirement or after retirement? There's no tax payable for gifts to people or organisations for that matter. But there may be some deeming, as we talked about earlier. So you've got to think about if you're over the $10,000 per financial year, or $30,000 over 5-year rolling periods, then you may be considered to still have that asset for a 5-year period, and that may impact your age pension. But there's no tax payable on gifts. Peter's just saying, for the teacher again, website to view. I haven't got the website. So, Peter, if you wouldn't mind just sending through the website. Red Cat Classroom Audio System. Okay, thanks, Peter. So I'll pass that through. Really appreciate you providing that information. It's great. Great community feel to the webinar tonight. It's fantastic. Gail, I am Jean John's wife and would like to thank you. Catch you next month. Oh, pleasure, Gail. No worries at all. Thanks for your questions and your interaction. Yeah, I'll see you next month for the more strategy-focused webinar. And thanks. So Red Cat Classroom. Thanks, Peter. Appreciate that. Now we're down to, I think we did Doris. David, looking after my parents. Looking after your parents, there's a range of complex strategies actually, David, and it depends on your situation. But well worth getting advice, because it depends on if your parents are living with you, whether you're living with your parents. There are granny flat provisions for Centrelink. There are life interests in your home. There's a range of strategies that could apply, but they actually have some significant tax implications and Centrelink implications. So well worthwhile considering those, or either through us, through an initial consultation, or through a financial information services office at Centrelink if you are wanting to go down the free track. Oops. Beverly asks, my husband is on a part pension because I'm still working. How can I be sure he is receiving everything he's entitled to? We could do that check for you. But if he's receiving a part pension, he'll be receiving the pension concession card. The only other thing is to go and meet a financial information services officer to check whether there's anything else he could be doing to increase his entitlements, for example. If you're still working because you are under pension age, then depending on how much you are earning, there may be some benefit in holding more assets in your name. That might be able to increase your or his part pension. We'll talk about that next in a bit more detail in the next month's webinar. Murray asks, optimizing income or investment income against pension income. There's a it's hard to know how to answer that one, Murray. It doesn't. If you had some numbers in there, it might be able to give a bit more detail. But really, if you've got assets and they're generating a return, then there's not much you can do really. You might be able to spend some more of the assets. If it's super, for example, you could go out and take a holiday and reduce your assets there, but then it just reduces the asset that you got. So there is, we can't really go into too much detail there because there's very limited info in the question. Gentilla says, part-time work, how to manage tax, how much should I do? Is it a drama to have it in big chunks rather than weekly? I think I should have largely covered that off in the work bonus section. So if you've got more intermittent work, then whilst you're not working and eligible for the age pension, then you accrue a work bonus, and then you can do a chunk, and the work bonus means that you won't be assessed on that work bonus amount that you've accumulated. Managing tax, salary sacrificing over certain thresholds of income can save you a lot of tax. So if you are under pension age, generally the tax threshold that you salary sacrifice income over is 20,500, but once you're of age pension age, it's about 29,000 because there's the senior Australians and pensioners tax offset. So a couple of strategies there. Might be worthwhile checking out the retirement planning series at cornerstonewealth.com.au/retire 2017. And Steve asks, should everyone select conservative investment options in super if close to retiring? You are still in for the long run. Yeah, Steve, it's a good question. Not everybody's different. Everybody's circumstances are different. People that have got a lot of assets, even if they're in the riskiest assets, they might be fully in 100% shares, but because the shares are generating sufficient income to provide for their requirements, then it's okay for them to be in those shares, because even if the value goes up and down, as long as the income remains pretty constant, it doesn't matter what happens to the asset value. But then so the key thing is to balance your liquidity requirements. One way we do that is to hold a cash reserve. So we might hold 2 to 5 years of pension payments in the cash or ethical cash option within your pension account, and then the rest in another investment option. And that could be ethical stable, ethical balanced, or ethical growth or ethical high growth, getting more risky each time. But if you've got a cash reserve that enables you to ride the market ups and downs, then you can sometimes take a bit more risk in the other part of your portfolio that you're not going to touch for a while. So it's all about creating liquidity so they don't have to sell down in low markets. So it's ideal to have that cash reserve regardless of which investment option you are in, the conservative one or the more aggressive one. A video that could help you there is on our website, and I think it's under cornerstonewealth.com.au/buffer, and it's talking about a buffer, creating a buffer for GFC type scenarios, so negative markets. David asks, the benefit or otherwise of keeping some or all of the accumulated super in an account after retirement. Accumulated super in the account after retirement. Yeah, after retirement, generally we don't hold it in the accumulation phase. We roll it all over to the pension phase, and it's just about the tax on the earnings. Zero tax on earnings in the zero tax on earnings in the pension phase. Whereas if you keep it in the accumulation phase, earnings are taxed at 15%. Jack asks, timing of converting super fund to a pension. Well, there's some key dates or key ages that you would consider moving to pension phase. You can do it at your preservation age, which for people turning 56 at the moment, their preservation age, is 56. So you can actually move to pension phase at that stage. But the benefits are minimal because the earnings on the account are generally not tax-free unless you have retired and don't intend to return to the workforce. So you consider moving to pension phase when you reach your preservation age, which is currently 56 for people now reaching preservation age. The other time you might consider moving to pension phase is 60 years of age. The reason for that is that drawings from super is tax-free, so it can create some cash flow that might enable you to do some other tax-effective things. Another age at which we generally move to pension phase is 65 years of age. It's a catch-all condition of release. When you move to pension phase at 65, the earnings on the pension phase are tax-free. So the key dates: preservation age, 60 years of age, and 65 years of age are the three sort of key dates that you might consider moving to pension phase, or if you satisfy condition of release in between those ages. Thanks, Peter. Yeah, look forward to seeing you at the next webinar, and thanks for your info for the other teacher. Appreciate that. We'll catch you next webinar. So we've done, I think Jack. That was Jack's question, the last one. So, Paul, what are the main financial steps to take to prepare for retirement and maximise the pension? What are the main financial steps? There's a good slide on the retirement planning webinar, which is basically pay off all your consumer debt, pay off your mortgage, use tax-effective strategies to save and build your retirement accounts or retirement savings. So that's about the government co-contribution, the spouse contribution, salary sacrifice to super, transition to retirement strategy if that works. The benefits of it have reduced, but there are still some benefits from it. So they're the key sorts of things that we focus on when you're preparing for retirement. Leonie asks, will interest rates rise more than 0.5% in the next 2 years? I've got no idea. Nobody does. Economists have all different ideas. You put 10 economists in the room and you'll get 15 different ideas of what interest rates will be in the next 2 years. We don't know. We are at record lows, so the expectation is that we will, the next move will be an increase, but it depends on what happens in the global environment and Australia's economy. There are so many variables. So in the next 2 years, we don't know whether it will rise more than 0.5%. Yeah, it's a bit of an unknown. So the key thing for you, though, is to try to structure your situation so that you can handle such an increase or more than an increase. In fact, the Australian Prudential Regulatory Authority is actually requiring mortgage providers to consider a 7.5% interest rate. So you might be able to borrow at a bit over 4% interest rates at the moment. But if you go and seek a loan at the moment, the mortgage broker will generally run your numbers on a 7.5% interest rate. They're doing that to try and peg back the heat in the property market, but it also is indicative that they're concerned that the next moves are going to be rising interest rates or increases in interest rates, and so you need to be able to afford those and factor them in. Delaney says we will be eligible for the age pension if we spend 3 to 6 months overseas. Yeah, I think I answered your question, Delaney, so I won't go into that again. Richard asks, with no house as an asset, how much can I earn before I lose my pension? Well, the income test is actually the same. It's the assets test that is different. Yeah, it's just the assets test that is different. But I guess deeming will be impacted in that respect. So just run your numbers, Richard, and see how your scenario will play out. Jill asks, would it be better to retire early and use some of your super so that you will qualify for the pension at retirement age? No, you're generally not best to finish up earlier. It's not best financially to cease work earlier with the idea that you'll spend your money and then be eligible for the pension. So overall, you're going to be worse off financially. But if it enables you to achieve your goals, as in you can finish up earlier and still achieve your goals, and the one way of achieving that is getting a part pension, then it could work for you. But it depends on your circumstances. Financially, you'll be worse off by doing so, most likely, but it might enable you to achieve what you're trying to achieve. So it could be a good strategy. Bruce asks, I just registered for the upcoming webinar. I have a question. I'm on the age pension, no super with a $100,000 mortgage. That's an impossible equation. I just started working 2 days a week to attempt to fix things, but that level of income will affect pension payments. What's the best strategy to minimise the effect on income on my pension and facilitate the reduction of my mortgage? I don't think there's much option for you. So the work bonus will help, as in the first $250 per fortnight will not be assessed, or the first time you've gone back to work, if you have accumulated a work bonus, then that will reduce the impact on your pension. But I don't think there's much option for you. If you're not able to pay off your mortgage, then you either need to downsize or continue to work, even though your pension will reduce, to try and pay down that mortgage. Thanks very much for your participation, and good night and God bless.